Can Uber become profitable in 2020? Firstly, I'm going to read you a great article written by Forbes, Beth Kindig, and then I'm going to share my opinion on whether this can happen. So Uber burns over $4 billion annually, yet the company is stating it will be profitable by the end of 2020. Further analysis is required to look deeper into whether Uber is able to accomplish what it has promised, or if the company is buying time and appealing for a more promising valuation before it has to raise more cash. The latter is something Uber is incredibly skilled at, as the company now trades well below its last private valuation of $76 billion, with a current market cap of $35 billion. Despite the coronavirus causing the company to cut back operations nationwide, with declines of up to 80% in ride-sharing volume, Uber is receiving analyst upgrades based on the company's variable cost structure. These analysts' upgrades come despite slowing growth and $7 billion in debt on the balance sheet, while being deeply unprofitable with record-setting adjusted net losses of $4 billion in 2019. The overall financial performance defies the CEO's statements, which are based on a single non-GAAP reporting measure, rides adjusted EBITDA. This non-GAAP reporting measure is new to Uber as of third quarter 2019 and replaces the less favorable contribution margin. Overview of Uber. Uber's revenue in the fourth quarter of 2019 grew 37% to $4.07 billion. However, it reported a net loss of negative $1.1 billion compared to a net loss of negative $887 million in the same period last year. EPS was negative 49 cents compared to 52 cents expected. Full year 2019 revenue grew 26% to $14.1 billion, and net loss was negative $8.5 billion compared to a net profit of $997 million for 2018. Stock-based compensation was $4.6 billion in 2019 for a net loss of $4.1 billion and adjusted EBITDA of a negative $2.73 billion. Notably, Uber sold some operations in Russia and Asia, which provided one-time income and caused the companies to post the $1 billion in net income in 2018. In 2017, Uber posted similar losses of $4 billion. Monthly active users, MAU, increased 22% to 111 million in the fourth quarter of 2019, helping to boost the company's revenues. The Uber Eats promotional expenses continue to drag the company's profits despite being the segment with the most growth. Earlier this year, the company sold its food ordering business in India to a local company, Zomato, in exchange for a stake in the company. Uber investors are encouraged by the non-GAAP rides adjusted EBITDA metric, which breaks out the profitability of Uber's ride-sharing business separate from Uber Eats and other bets, such as autonomous vehicles. Uber reported a 281% increase in rides adjusted EBITDA from $195 million to $742 million in the fourth quarter, and a 34% increase from $1.54 billion to $2.07 billion in full year 2019. The company's overall EBITDA margin is negative 57.58% compared to the sector median of 12.99%. The company stated on a recent call to investors that they have 10 billion in unrestricted cash. Uber carries long-term debt of 5.7 billion and a capital lease obligation of 1.5 billion, or about 7 billion total in obligations. Despite the combination of steep losses and ample debt, the CEO stated the balance sheet is incredibly strong due to the absence of short-term debt. There is clearly a sharp contrast between the financials and the CEO's statements, which means Uber has a lot to accomplish this year in the face of coronavirus shutdowns. Analysis of adjusted rides, EBITDA. Uber has been opportunistic in breaking out adjusted EBITDA for rides as a means for reaching profitability. In the 10th quarter details, Uber does not break out the number of ride-sharing trips and monthly active users separately from Uber Eats and Freight, although there is a statement in the summary that gross bookings grew 20% and Eats grew 73% over a year. Gross bookings is defined as the total dollar value including taxes, tolls, fees, and without an adjustment for consumer discounts and refunds. Essentially, gross bookings is similar to ride revenue, the metric that Lyft reports. Uber's gross bookings growth is actually quite low at 20% compared to Lyft's ride revenue at 52%. Some of Uber's weaknesses and risks are known to the market. This is the one reason the price to sales ratio is very low at 2.3 with a forward price to sales of 1.7. Compare this to other companies that went public last year, such as Zoom Video with price to sales of 53 and a forward price to sales of 39, or Slack with a price to sales of 17 and a forward price to sales of 14. Uber may look attractive to some investors at this current valuation given the risks. However, this is a company that is far from true profitability across all revenue segments. So now we talk about the subsidies inflate demand. I've been critical of the ride-sharing business model since pre-IPO, when the media speculated Uber would reach $100 per share. The problem with the ride-sharing business model is that the more money the business makes, the more the business loses. This is reflected in the past 3 years of financials between 2017 and 2019. Essentially, Uber and Lyft used private fundings to subsidize rideshare demand in the last year leading up to their public filings. In 2017, Reuters published that Uber passengers pay only 41% of the actual cost of their trips, citing research from transportation consultant Hubert Oren. At the time, Reuters warned that this creates an artificial signal about the size of the market after Uber had released limited financial data as a private company that showed losses of $708 million per quarter. The cost of the ride is not high enough to cover the cost of the ride. Therefore, we see unusual losses. However, if the companies raise prices, demand will decrease. These companies must choose between subpar growth in order to become profitable or subpar earnings in order to drive demand. The markets did not reward Uber for driving demand at the expense of its bottom line. Instead, Uber became the biggest IPO loss in history. Uber is attempting a new path, which is to pare back on losses while accepting lower demand and revenue at 20%. This is most evident in the problem. This is most evident in the problem with this scenario is that the market may not like slowing growth either. In fact, we see trips growing 32% year over year, which is much lower than the 100% growth reported in the first S1 filing, when trips had doubled from 5 billion trips in September of 2017 to 10 billion trips in September of 2018. Revenue should be aligned with the number of trips and also doubled unless subsidies were very steep. It's also important to note that Uber removed the original non-GAAP measurement contribution profit loss and replaced it with adjusted rides, EBITDA. This is because the contribution margin was too revealing of Uber's losses, with a declining rate from 14.7% in the second quarter 2018 to 8.2% in the second quarter 2019. Lyft, pure play model. Lyft provides a model for a pure play ride sharing company with a reported 52% year-on-year increase in its fourth quarter 2019 revenue to 1.01 billion, up from 669 million. This is much higher growth than 20% Uber reported for its ride-sharing segment. For the full year 2019, revenues decreased 68% year over year to 3.6 billion. Net loss increased to 356 million from a net loss of 248 million in the same period last year. Yet, on an adjusted basis, the net loss margin was slightly higher in the current year at 35% compared to 37.2%. Adjusted EBITDA loss margin improved from 37.5% in the fourth quarter 2018 to 12.9% in quarter 4 2019. More importantly, Lyft has remained consistent with its non-GAAP metrics and reports on contribution margin of 54%, up from 45.5%. In my opinion, Lyft's financials are more straightforward in how the ride-sharing model can achieve profitability while maintaining enough growth to satisfy tech investors. Beware of a changing story. The last thing to note, which is quite important, is the story for Uber is changing frequently. Uber Eats is driving the growth and is the more stable part of the business in the current coronavirus economy, yet a portion was sold off to India to lower expenses and achieve profitability. Autonomous vehicles were a major part of Uber's story due to concerns around drivers who bring never-ending legal battles on the misclassification of employment. In as recent as January, autonomous driving was the most likely path to profitability for Uber. The story has changed entirely in 2 months' time, yet it will be quite challenging for Uber to separate autonomous vehicles R&D from its financials. CEO Derek Khosrowshahi highlights the variable cost structure of the business, which translates to not having to pay drivers employment benefits. Notably, the misclassification of employment is receiving renewed criticism with the ride-sharing business shut down from coronavirus. The workforce of 5 million drivers have no unemployment, sick leave, or health care. Although company is offering sick pay for drivers who test positive for the coronavirus, this does little for the majority of the drivers who are ordered to stay at home to avoid the spread of the virus. Now the company is now asking the government to offer the drivers benefits while Uber highlights its variable cost structures to investors. The conclusion, ladies and gentlemen, the statement that Uber will be profitable is confusing at best, as the company cannot simply separate the ride-sharing segment in order to make this claim. Even if this was possible, the ride-sharing growth is the lowest across all segments at 20% and ignores the catalysts of Uber Eats and the autonomous driving division. In a recent call, Khosrowshahi stated the company has 10 billion in unrestricted cash. Yet the CEO also stated the company could lose up to 6 billion from the coronavirus quarantines. I believe Uber will need to raise more money in the near future and will do and say whatever necessary to raise its market cap before doing so. Disclaimer, Beth Kindick has been a short seller in Uber and Lyft with on-off trades since their respective IPOs. Okay, that's the disclaimer there. Now, great article written. My take on this is pretty simple, that as of today, March the 26th, Uber and Lyft really don't have game plans for the coronavirus, nor do they know how long this will be drawn out. I personally cannot see this company being profitable in 2020, yet alone in 2021, right? And as a professional that is in touch with those 5 million drivers mentioned here, through my channel, receiving daily updates, daily news, text messages, emails from drivers, from real drivers, I can assure investors and the public there is such a disconnect between executive management and the workforce labor. In fact, the disconnect has never, ever been higher. Uber has left drivers in the dark during the coronavirus, and there is such anger and resentment towards the company. They are not making these monies available. What they're basically saying, drivers go out, they get sick. If you are sick, come back to us with a letter from a public health organization, then maybe we will attend to you. The bottom line is drivers are dying, the drivers are fed up, and the drivers are not doing trips anymore. So we should be looking at several months of no to very little earnings being brought in the rideshare segment, right? Uber Eats is seeing a small boost, but at the same time, so are Postmates, DoorDash, Grubhub, and Instacart, right? They're taking a lot of those upset, non-paid Uber and Lyft drivers, they're taking them up. So, people might be transitioning out of driving to food deliveries, right? As the coronavirus subsides, maybe in a few months, it's possible that the rideshare sector will pick up again. I believe Dara Khosrowshahi is a master in juicing numbers, is a master in promises. As you can see, last week he had the conversation with investors only. He did not address his labor force. He doesn't talk to his labor force. He knows how much his labor force, the drivers, hate him. They really do. I can tell you that. So there is no goodwill towards the company. There's no, hey, I'm going to go out there and do this for my company. Drivers, I can tell you, feel like Uber have truly, truly left them in the dark. So I see 2020 as being the most challenging and troublesome year for Uber. I see massive losses this year, massive losses. And I'm not quite sure how Uber is going to make that up in 2020. Now, the $10 billion cash at hand, I believe they will be burning through that extremely quickly. They still pay themselves supersonic salaries, upper management, middle management, and lower management. They still pay those salaries. They are paying for all the hubs in all the cities. Those rents are not going away. Yet the trips, the revenue from the trips is not coming in. So that $6 billion will go like that. And then they're going to have to resort to their cash revolver. They hit that $4 billion mark. They're going to have to take on a lot of money in 2020 and 2021. So temporarily with the $2 million stimulus, you saw a brief spike. It went down to a low of 14. It's come back maybe up to, as of today, $27. But I believe in 2 quarters from now, more towards the mid or the third quarter of this year, we're going to see a very, very strong decline in the stock price, right? Drivers, for example, the words that's on the street, hey, when this thing hits $7 or $10, we'll buy in, right? Even drivers want to jump in at that level. So they believe this stock is going to tank. And with poor management, I don't see any leadership. I don't see any leadership skills from Dara. He's an introvert. He's not what the company needs. SoftBank and others are pumping money and keeping this Titanic afloat. But if you really want to reshuffle things, get upper management out, get some competent leaders in that are willing to talk to the labor force, namely the driver, and maybe in 2021 these things can be turned around. Have a great day. Thank you.